Daily losers attract two opposite mistakes. Some investors assume every sharp decline is an opportunity. Others assume every decline proves the business is broken. To test what actually happened, I built a reproducible sample of 100 large company losers and measured their adjusted price performance over the next 63 trading sessions. This is a retrospective, not a trading recommendation, and it does not claim that terminal investor flagged these stocks at the time. For each constituent, select its worst daily return in September 2025. Retain the 100 largest drops. Measure adjusted price return over the next 63 trading sessions. This design gives us one event per company and avoids filling the sample with repeated declines from the same name. It also introduces survivorship bias because current index membership is used, so the result should be treated as descriptive evidence rather than a precise market-wide estimate. The median stock in the sample fell 4.9% on its selected event day. That is a meaningful repricing, but a falling price tells you nothing about balance sheet strength, normalized earnings, or competitive position. The drop only creates a research candidate. A value process still has to distinguish temporary disappointment from permanent impairment. Over the next 63 trading sessions, the median return was 4.1%, and the mean was 9%. 59 of the 100 stocks finished above the event day close. 35 gained at least 10%, while 19 lost at least another 10%. The dispersion is the important result. Buying the loser list indiscriminately still exposes you to severe downside. The three strongest subsequent returns in this sample were Light, 153.6%, SNDK, 145.3%, ALB, 76.2%. These examples show why contrarian screens are worth running, but they do not prove that a price drop predicts a rebound. The same sample also contains stocks that continued falling. A credible workflow must explain why a candidate deserves attention before highlighting the rebound. This is where Buffett and Graham-inspired checks become useful. Earnings stability helps reject businesses whose economics were already deteriorating. Free cash flow tests the quality of reported profit. Debt and interest coverage identify companies that may not have time to recover. Conservative valuation helps determine whether the new price includes a genuine margin of safety. These filters cannot eliminate losses, but they make the research queue more defensible. The limitations matter. The sample uses current S&P 500 membership, which creates survivorship bias. It is a price-only retrospective and does not prove that terminal investor flagged any company on the event date. Trading costs and taxes are excluded. Most important, one historical period cannot establish a persistent strategy edge. The right conclusion is narrower. Daily losers contain both rebounds and continuing failures, so a structured fundamental filter is essential. Terminal Investor is designed for that workflow. It turns a noisy list of fallen stocks into a ranked research queue, applies consistent quality and valuation checks, and surfaces risk flags before you spend hours on a company. You can review the sample report and test the screen during the free trial. Treat every result as educational research and complete your own due diligence before making an investment decision.